The price of gold has gone above 3,200 pounds. Yes, it's corrected, just like the dollar price is corrected. So I actually think it's a great window of opportunity to actually exchange your spare fiat pounds that you have on deposit or wherever for real money, for gold.
If you have the gold, it holds your purchasing power intact. Actually, this is more accurate. It holds your purchasing power intact. And so then it will be time to exit some of this, and depending upon what we're looking at, whether it's rights or income producing real estate or even dividend paying stocks that have actually survived this, etc. Then we start to exit out of this and convert into those income producing assets when they are severely undervalued.
This is what you need to keep an eye on, and I'm going to bring up a chart here of cable, which is the nickname for British pound versus the dollar, the exchange rate or the pair. And the reason they call it cable is because when they laid the telegraph cables underneath the Atlantic for the first time in the 19th century, they were able to trade between London and New York instantaneously. They knew the quote, so they called it cable, the foreign exchange market. Anyway, I noticed yesterday that the pound dropped to some key technical level, which is around 131.50, 131.40, and you can see by this chart that there's a floor there, and it's a very precarious situation right now. The chart looks like it's topping, and I think when we go through, because I think we're going to go through that level, we could accelerate lower, and yes, that could help the price of gold and sterling go up, even if gold doesn't go up in dollars. And we're going to come to gold in a minute and how I'm protecting my savings. It's you might want to listen to it. Of course, a lot of you know already, but you can see here on this chart that back in May of this year, we tested that level, it held, and then we went back up, and then we dropped back, and we retested it in August, beginning of August this year, and then we went back up, and notice that we went back up, but we didn't go higher than the level that we went up to back in July, which was just below 138. And I'm not surprised, because if you look at the really long-term charts, back during the 07, 08, 09 crisis, the pound dropped from above $2 all the way to 135.90. So this 135.90 area is a huge resistance, and I think it's failed.
Zooming in, the pound's chart suggests a test of critical support. The 1.35 region was breached in past crises, 2007-09, when sterling dropped from above 2.0 to around 1.36. In recent months, the pound held, then retested, and failed to extend higher. In 2025, the weakness has reignited. Traders are now pricing in almost a 68% chance of a rate cut by the Bank of England in December. Add in budget gap fears and slowing growth, and sterling may accelerate lower. For gold and silver investors, a weakening pound can translate into stronger bullion denominated in sterling, even if the dollar price stays flat.
And yeah, so I think we could go a lot lower. It's going to accelerate as well. And I think maybe a Bank of England rate cut next week could do the trick. But yeah, I think it's just time for the pound to weaken. Yes, to gold. Well, I was looking at the gold price in sterling. And last year we closed, according to the LBMA AM fix on the 31st of December 2024, we closed at 2,083. And right now, the price of gold in sterling is at 3,008. I took 3,000 as the rate today. It's fluctuating, of course, but that's an increase of 44%. And recently, of course, the price of gold has gone above 3,200 pounds. Yes, it's corrected, just like the dollar price is corrected. So I actually think it's a great window of opportunity to actually exchange your spare fiat pounds that you have on deposit or wherever for real money, for gold. And as I've always said, I try to buy gold and silver as well whenever I can. Yeah, I try to kind of not buy when there's euphoria. And sometimes I even like buying when the market is kind of negative, a little bit like it is now, I think. So I think it's a great opportunity. And some of you might not have bought gold before. So I'm going to talk a little bit about gold here in the UK as an investment or as an insurance, if you want to call it. The important thing to note is that coins of the realm, so sovereigns and Britannias, they're capital gains tax free. That's very important. I didn't know that back in 2002. I started buying gold. I bought Krugerrands. Eventually, I swapped them for sovereigns because I learned about it.
Let's shift to bullion. In the UK market, gold is no longer just about USD spot. In sterling terms, the rise has been dramatic. While previously closing around £2,083 per troy ounce at end 2024 in one UK fix, the price is now in the region of £3,000 plus, roughly a 44% uplift. This reflects both currency weakness and gold's own rise. Against that backdrop, a window for accumulation appears. Coins such as sovereigns or Britannias offer retail investors access, and in the UK there can be tax advantages, e.g. no capital gains tax on UK legal tender gold coins. Bars also work, but check premiums and storage.
But yeah, so here's a sovereign, and the sovereign is 0.2354 of a troy ounce. So if you take that 3,000 price, you multiply by 0.2354, you should find the price for the sovereign. Of course, there will be a premium from the dealers. And I think it's probably, let's see where it's trading right now. The sovereigns, yeah, they're going for like 760 pounds with the premium. And if that's too much for you, if you can't afford that, you can also buy a half sovereign. So a half sovereign is just half of a sovereign. The calculation is very easy, of course. And then for those of you who are fortunate to have big fiat currency deposits or sterling deposits, you can you opt to buy one of these. It's a 1 troy ounce Britannia with the Queen here. There are King Charles ones, if some of you prefer King Charles. I'm not too sure about that. But let's see how much they're going for. You see, with gold, the spot price just above 3,000. They're going for about 3,185, maybe sometimes 3,200, depends on the dealer. So I think that's the best way to own gold in the UK.
They aren't the unimpeachable safe harbor asset that they were once, well, at least that they appeared to be. And it's a phenomenon repeated across the bond markets all over the world. Those long-term bonds, we've talked about this quite a lot. And as you can see, the percentage of foreign officials' share of outstanding treasuries, we've talked about this over and over again, they've dropped from over, well, I think in 2008, we were at 45%, and now we're down to like 15%.
Beyond retail, the big story is central bank behavior and structural currency risk. Global central banks added 220 tons of gold in Q3 2025, up 28% from the prior quarter. The logic: with real yields under pressure, fiat currencies under strain, and geopolitical risk rising, gold is serving not just as an inflation hedge, but a monetary sovereignty asset. Analysts such as those at Yardeni Research project gold potentially reaching $10,000 per ounce by 2030 if trends persist. Meanwhile, the notion of a debasement trade is increasingly referenced, currencies losing value relative to hard assets. As fiat purchasing power erodes, gold and silver gain relevance.
Hence the stable coins to create a new false market. And what about gold? Well, global central bankers have been loading up on gold, and who knows more about what they're doing, about that devaluation trade. That's the central banker's job, is to devalue the currency, but to do it in a way that you don't notice. But now we're at the end. And so things that once worked no longer work. And when you see these titles, the debasement trade, what they're really telling you is that it's time. They're telling you that this is the end of the system. The fact that they're so darn blatant about it. And why aren't people more up in arms? I suppose that's what's showing in the spot prices on both gold and silver. But I'm going to tell you, the physical markets are now overwhelming the paper markets. We're in the most interesting place that we could ever be. And we need to talk about this because seriously, the fact that they are touting the debasement trade, and we've got headlines around it, the debasement trade is ripping across world markets because all of the global central bankers, they have no tools left. It's just more debasement. And the more that happens, the faster the inflation, the less confidence that the public has, both in the markets and in those that are leading the markets. And what's the goal here? The goal is to make this transfer into a surveillance system without you complaining, without you realizing that that's what's happened. But you're here, so I know that you do realize it. And I know that over time, you've seen me over and over and over again show you how silver protects your ability to buy the same goods and services over time. Gold actually expands it. And gold is outperforming every single fiat currency. Every single one of these, physical gold, physical silver, is outperforming and has been for a very long time, going all the way back to 2000. So now I'm going to take questions, but I really want to talk about what you think of this debasement trade. And do you really understand what's happening at a level that you can explain it to other people? Because you can just take a headline and show somebody and say, do you know what this means? This is why, this article is why you need to have gold.
If you view metals as insurance, here's how the layers come together. First, maintain a baseline of cash plus physical precious metals you can both hold and redeem. Second, convert part of fiat wealth into metals and other defensive assets, especially when valuations for stocks, bonds, or real estate are lofty. Third, think of exit strategy. When inflation recedes and assets reset, you can convert from gold into income-producing assets or pay off debt, e.g. mortgages, using gold proceeds. In this way, your principal in metals safeguards you during the transition. When the new system emerges, you redeploy. Taxes, fees, penalties matter. They are tools of the system. Be explicit about when you pay rather than letting the system decide.
Period. Deb Warner asks, Lynette, can you give a broad overview of what the exit strategy will look like for most folks? I appreciate and respect your advice. Now, it depends on, the strategy is built in layers from sustaining your standard of living. So the exit strategy actually in there is to have a level of cash, maybe a level of gold backs, maybe a level of glint or some kind of electronic convertible gold, or redeemable gold, you must have the ability to pull it out or I cannot support it. And actually, that's the kind of gold and silver that you use up as you need to sustain your standard of living. So that's one of the parts. And remember, this is built in layers, which means that there are layers in each piece of the exit strategy. We also want to protect the fiat money wealth or whatever wealth you've managed to accumulate. So real estate is a great example of that. And let's say you're sitting on a mortgage. Well, part of the exit strategy is the ability to, when they do that first overnight reset, and I'm going to show you this in more depth, but when they do that first overnight reset, boom, the exit strategy there is to convert as much gold as you need to into whatever the currency of the realm happens to be, whether it's dollars or it's CBDCs or it's stable coins or whatever it happens to be. Convert enough gold to, bam, pay that mortgage off. So that's another part of the exit strategy. Then, as we are moving further through this trend cycle, and those income producing assets that right now have been targeted for reflation, so they're at absolute nosebleed levels, plus those zombie corporations that really should not be existing but have been kept alive for a variety of reasons that we've talked about in the past. We need all of that to wash out, because in the real world, things always go from undervaluation in the tangible asset world, I should say. From undervaluation to fair valuation to overvaluation to fair valuation to undervaluation. That is a constant movement. So right now, they're at the extreme because people watch the markets go up, whether they're real estate or stocks or crypto or whatever it is, and they go, oh, that's good, that's good. But that's not the real trend. The real trend is the value of the currency going down. Having said that, when all of that inflation is burned out, so you have them going from here down to an undervaluation level, and we see who survives and what is exactly happening in there, well,
So what happens next? If sterling falls further, the UK consumer and investor will face higher import inflation, weaker purchasing power. Gold priced in sterling may rocket. If central banks keep buying gold and real yields stay low, the gold rally has fuel. A possible outlook: gold could continue to outperform fiat currencies globally. Silver may follow, but with greater volatility, and the dollar-pound dynamics warrant close monitoring. Your task: set clear allocation targets. Decide how much gold, silver you're comfortable holding, and revisit periodically as regimes shift. Whether you are right or wrong about timing is less critical if your strategy is layered and diversified. The ultimate goal: preserve purchasing power, protect wealth, and be ready for the transition.
if you have the gold, it holds your purchasing power intact. Actually, this is more accurate. It holds your purchasing power intact. And so then it will be time to exit some of this, and depending upon what we're looking at, whether it's rights or income producing real estate or even dividend paying stocks that have actually survived this, etc. Then we start to exit out of this and convert into those income producing assets when they are severely undervalued. And in essence, as an overview, that's the exit strategy of when you get out. But the other part of the exit strategy is making sure that when you use your barterable portfolio, remember, this is your principal. You're using up your principal. When you're converting your gold into fiat to pay off that mortgage, again, you're using up your principal. When you are using your gold to convert into income producing assets, again, you're using up your principal. But that doesn't do you very well when we're in on the other side of this transition. So a big key component of the strategy is the principal that you are likely to use up as we are going through this trend cycle gets recouped. So that by the end of it, when we're in the new system, and believe me, we are not going away after we go into the new system, because everybody should always have a foundation of sound money in their portfolio to protect anything else they want to do. So we'll evolve as you guys evolve, but that's a big part of the exit strategy, is to recoup any of that, the principal that we use, any taxes, because taxation and fees and penalties and fines, these are tools that the governments use to keep you in the system and prevent you. I mean, if you read their documentation when they're setting things up, what do they say? They say, well, how much of a fee, like when they changed the money markets, it was how much of a fee do we need to charge so that when people see that, they go, oh, no, I'll just leave it there. That's the main focus, not on protecting your wealth and your assets. But what do they need to charge you? It's the same thing with IRAs. People go, oh, I don't want to pay those taxes. Well, you're always going to pay those taxes. You can decide when and how you're going to pay them, or the government can decide when and how you're going to pay them. That's up to you. But no matter when you choose to do it, we want to make sure that whatever fiat money wealth you've accumulated, if that goes to zero, it doesn't impact you. What if I'm right? What if I'm wrong? This whole strategy is about it not really mattering if you're right or wrong, because we're going to cover every single base.